Good morning, traders. I just got done with the TT scanner video, so I'm starting with the same chart now for the MENT Rotational Modeling and Real Estate video this week. Today is December 31st. This is Brad Matheny. Let's go ahead and get started. First things first, I want you to pay attention to what's really happening. We're going to go through about 30, 60 days of the markets transitioning. Could be very volatile. I'm going to go over my expectations, and I'm going to go over a caveat scenario that will protect us in either way. But I also want you to be aware that there's going to be some pretty big changes on my website coming up in 2023. We're going to be changing things up. I'm going to be restructuring some of these videos. I've got some new custom index features that I think are very powerful and will help you out. But for right now, we're going to go through the real estate and MENT Rotational Modeling System. These are the newer videos. I'm trying to restructure these to get ready for the new 2023 member services and solutions. Okay, in the TT Scanner video, I went through my expectations that we're very similar to a, in fact, let me come over here and get rid of some of these, and we will highlight that. Okay, what we want to try to highlight right now, ladies and gentlemen, is this inverted head and shoulders formation right here that is setting up, as well as the excess phase peak, which is a rally to a new high, a roll down to a subsequent base, and then we want a flagging formation to set up like this, which is really the A, B, C formation of a excess phase peak pattern. Now, in this scenario, what usually happens, ladies and gentlemen, is that we will either see this rally to continue to take out this high level here, and at that point, we have ended the excess phase peak right here pattern. It's no longer valid once this takes place. Okay? This means we've moved to a new high. We should expect it to continue to move to new highs, and that means we would want to continue to see this move higher. Or what will happen here is we will continue to flag out, roll downward to a phase 4 base, which will extend potentially many, many months into the future and eventually potentially break down. Now, the excess phase peak pattern generally can at any point end. So it can end off of this base here, which would be a continued rally upward. It can end off of this phase 4 base here and rally upward. Or it'll go all the way down to an extended deep, deep low, form a basing bottoming pattern, maybe much below this 3,000 level, and eventually start an accumulation back to the upside. So we have to be aware of what's called failure to succeed in trading. So when you're involved in trading, there's really two outcomes. When you look at trading and you determine what is likely to happen, you are predicting what you believe has got the highest probability. That would be what's called the failure to fail mode, meaning your most likely outcome is the non-failure of your trigger. The failure to succeed means what happens if your predicted outcome is wrong and it goes in the opposite direction. So what we're doing here, our failure to fail mode, would be that we see this flagging formation continue to move higher, break this previous high here, and attempt to break above new all-time highs, back up above these levels. Failure to succeed, failure to actually do this, which is what I believe is likely to happen, would mean that we move into a failure mode, which would be a phase 4 move down here. And that's where we need to be aware of what's happening right now in the U.S. markets. The U.S. markets are, let me get rid of these crazy lines I've drawn. Oh boy, lots of crazy lines. Okay, the U.S. markets are setting up in this inverted head and shoulders formation, and this is, let me get it a little bigger, And this is really where we're at sliding into the early portion of next 2023. What's going to happen, in my opinion, technology is going to come out strong. Consumer staple products are going to come out strong. More than likely, raw material miners and suppliers are going to come out strong. Remember, they pass their costs and the additional profits off to consumers. Financials, automobile sellers, and potentially real estate firms could be really under some extreme pressure this year. And that means that you're going to see really, and retail could as well, certain retail. Higher end retail may not be touched so much. Intermediate high end retail, let's figure in my world, that's kind of like the Macy's and the, maybe not the Tiffany's, but the Nordstroms, things of this nature. They may end up having some real issues, especially in the fourth quarter and going into Q1 2023. But understand that, you know, there's people right now that are trapped in very heavy expenses. I just watched a video about what the average person, I mentioned it last week. I know a couple people who have gone out and bought new cars recently, and you know, they're dealing with $900 to $1,300 a month car payments, and you know, those types of things hurt. You know, when you get two cars and you have your basic expenses and your higher interest credit cards, and you know, you're talking about dropping $15,000, $18,000 a year just to have a car. Out here in California, you need a car, but you know, dropping 20 grand a year on a car is, to me, a little crazy, especially for something that just depreciates in value over a 3 or 5 year time frame. It's nutty. But again, what we need to see is how this plays out. You've got consumers pulling away right now. You've got, in fact, let me go to the charts. So we're going to start here. The MENT Rotational Modeling System, nothing has changed. We are still, and this has been this way since early 2022. We've had a couple of changes here to the daily system, but the weekly system has stayed bullish. Daily system has continued bearish. Combined position is 50% cash and 50% bearish SPY. The MENT Rotational Modeling System, these are the same from last week. Nothing has changed. Very, very moderate change last week. We still have 20% stocks, 55% cash, 25% metals. Metals are starting to accumulate nicely. Stocks are 20%. This is the alternate method, which does not include metals. That's 20% stocks, 80% cash. This is very safely protected. Remember, through most of 2022, in fact, through almost all of 2022, we've been close to this position. We've been safely in cash and metals and stocks. Now, granted, we've had some fluctuation, but the reality is the MENT Rotational Modeling System has performed very, very well. It's not positive this year. At the end of the year, I was hoping it would turn positive, but this is a very flat year. So we've made a little money in some of our positioning into stocks and swing trades, and particularly metals recently, but the exclusion of those alternate positions, not counting the strength of the US dollar. Remember, this does not take into consideration the appreciation you've had with the strength of the US dollar, but we're at minus 0.60% this year. If anything is similar to these years where we have a decline like 2007 and 2011, we will likely see some fairly big advances in these numbers through 2023 and 2024. You know, maybe in excess of 25, 35% over a 2 or 3 year time frame. Okay, next, let's go to these. I'm moving these over. This is the real estate update, page 1. Real estate data was late this week. I guess everybody's preparing for the end of the year. Price reductions are lower. Active listing counts continue to move higher. Now, again, reductions are still well above 100%. So even though they've come off of call it 122, they're down at 108, hypothetically. There's still pretty much everything on the market is being reduced. Median days on market is flattening out, inching a little bit higher here. We haven't seen any real collapse in prices, but prices have started to move downward. You can see this blue line here. That's, again, continually moving downward since April, May, June. And then we have new listings share of market, or price reduction, sorry, share of market is still staying relatively high. So you've got share year over year. You're basically seeing the market transition. Demodeled market demand and price factoring are staying very, very low. These are the lowest levels we've seen in 2 years. This is telling you that that there is no real demand for housing right now. There is a minus 36.24% demand for housing and a minus 45.03% pricing factor. This does not take into consideration the new 50 basis point rate increase by the Fed last 2 weeks ago. So understand that these numbers are likely going to change fairly dramatically, I would expect. I think the bottom is going to start to fall out of the housing market here. We'll see how it plays out, but right now I'm surprised that price levels are holding up the way they are. We will see. Over the next 2-3 months, we'll see how this plays out if we get any real disruption in the market. That's why we're looking at these next couple of charts here to see if we get a disruption in the market. Price reduction activity here is up near 100% share of market. We are seeing it start to roll over a little bit here. We saw a bigger amount of reduction activity. This was back in March, April, May, June. Now it's starting to wean out here at about 40-50% in reduction activity. Active listings are at the new high. This is the highest level we've seen in almost 4 years. So understand that there's a ton of houses coming on the market. Inventory is building. Read an article just yesterday that said that we're now at about 4 months of inventory on the market, whereas we were down at like 20-30 days of inventory on the market back over here in 2021, early 2022. So we're seeing inventory really start to stack up. Price trends flattening out, moving a bit lower. We're not having any real depreciation yet. It's just like taking nickels and dimes off the top of the price levels here. But again, the market has yet to really deteriorate. We've seen internals deteriorate. Demand is deteriorated. Give you an example. As I understand it, title companies and escrow companies are really struggling right now. Real estate agents, again, are really struggling, but that's not being shown in actual price levels for real estate. You're not seeing a 15, 20, 30% decline in prices yet, but activity has dropped considerably. You're just not seeing the same sales volume take place because buyers aren't around to be scooping up homes that are still relatively high priced with higher interest rates. It does happen, but it's just not at the same frequency that we saw back in 2021 and earlier. Okay, new listing count metrics. So we have new count, highest level we've seen. It just keeps moving higher. And I remember when I started talking about this moving up, I said it's just going to keep attributing. So we're going to continue to increase this level. I expect that we're going to be up in the 70-80% area by March, April, May, and go from there. So let's come over here and take a look at the heat rank. Heat rank is starting to soften a little bit. That means that we're getting into weaker real estate demand, weaker activity. The tightness index has flattened out into negative territory here. We saw this bit of a recovery here. I think what this was is end of year accumulation. I think those that could afford made the move before winter got here. And now we're going to look at winter actually ending. You can see here's December 2021. You can see it was weaker, and here's December 2020. This was the, hate to say it, but this was the COVID hype. It was a fairly mild winter, and everybody was going crazy during COVID. But I think December, we're going to see inventory in the first part of the year really start to weaken. So here we had weakening into early 2021. Here we had strength into early 2022. Remember, this was when the Fed was raising rates, so people were trying to get the last deal before rates really went higher. And now we're way over here. We're slightly above positive territory at like 4.4%. And I think we're going to roll over pretty hard in the first quarter of 2023. Seller desperation, I inverted this to try to give you a better idea of desperation. This is an area here in June, July, August. This is when desperation hit. This is when desperation was mild. And now we're starting to see moderate, mild desperation here. We'll see how it plays out over the next couple of weeks. So what's really important right now, ladies and gentlemen, is that we have a fairly strong recovery mode in the U.S. leading index, meaning that we're looking for a base or a bottom. We need to see this hold up. This is really our inverted head and shoulders formation here. You can see it kind of set up right here. We're looking for a base or a bottom. We're looking for the U.S. markets to try to struggle to stay up above this level, maybe in Q1 2023, maybe attempt to move a bit higher. But in reality, like I said, I think early, particularly January, maybe early February, could be a bit of a struggle. So it's either going to be one of two things. It's either going to be a bit of a struggle where we see downward activity, or we're going to see something come out and really prompt an upward move. So we'll see how it plays out. Next, we have the real estate dynamics. This is a new update that I created, a new chart. Very interesting to me that we start to see, and I had to play with this standard deviation channel, this pitchfork, because I wanted to really highlight the extreme pricing level in 2005, 6, 7. Back over here, you can see this is really extreme pricing factor. And this is where the Fed raised interest rates. This is where it became, think of this as threatening. This is a very hostile housing market over in this area. So up in this upper blue area, we get a little hostile. It becomes less tolerant for buyers to become very active. And you can see here after 2018, we moved into, and this is 21 here, so 17, 18, let's see, 19. So this would be 20, 21, right over here in this area. And you can see we moved into this extremely hostile environment. And then because the Fed lowered interest rates so aggressively after COVID and everything became very flush with cash, we move from these extreme levels down into a near extreme buyer's paradise, really, as long as you were willing to deal with the fact that prices were already extremely elevated. This became a buyer's paradise. The lowest levels, meaning the most opportune buyer's paradise level that we have seen in early 2021, we've never seen anything like this. I mean, literally never seen anything like this. But look at how quickly things changed. 2021 into early 2022, we have now moved up into the highest, most hostile environment pricing structure for real estate in the U.S. that we have seen pretty much going all the way back to 2000. We've never seen anything this hostile right now. This is a very difficult market for real estate. And I wanted to highlight here home price index. We moved off of these extreme hostile environments back over here. You can see back over in this area. We moved into an unprecedented area here with an extreme rally phase here. We could very easily move back down into these levels here. So hypothetically, we're at 370, doing the math right, 370,000. We could move back into these lower channels, which is 270,000. This would be about a 25 to 30% decrease in house prices. And if the Fed stays at current interest rates, that would move this level down into, in my opinion, this lower channel level, which would put it in near equalization. But in order to prompt buyers again, you'd probably have to get down into this lower level, which would mean Fed would have to probably drop rates by about 1.5 to 2% to spark things. And we could be looking at that, but it's probably not going to happen for another 12 to 24 months. So understand that this could unwind. back down into this neutral area, back over here, becoming less hostile. House prices could unwind back down into this neutral area here, like 320, 330. But the reality is, if the Fed's still battling inflation and potentially raising interest rates, the hostile area is going to stay up here. The downward pricing structure is going to stay in place. Instead of a crash like we saw back over here, which was the global financial crisis event, we could see more of an unwinding event leading to this 2025 cycle here. Remember, this 2025 cycle is literally 28 months away. So we have a very long cycle phase to potentially unwind, and where we're going to end up near this potential base bottom cycle phase, maybe in this 270, 280 base price range, maybe closer to 300. But understand that would be right in this area here. And that would mean that we would potentially stay in this elevated, hostile environment, maybe another year, and then start to weaken before we find some sort of a base or bottom back over here around the end of 2024, beginning of 2025. Next, we have the fear index. This is a general market trend. We're slightly elevated on fear. Above 7 is a higher fear level. Above 10 or 11 is a next highest level. And then, of course, we start getting into the extreme fear. We're not seeing extreme fear yet. So you can see here the COVID levels here. This was the rotation through these downtrends. Unless we see a big downward cycle event, we may not see a big broad fear event here. But the market sentiment index has come down off of these extreme lows. Remember, this was the COVID low. We can carry this all the way back over here to 2019, very close over here. So once we get down to these extreme kind of an oversold level, then we tend to try to find some support. Now, we could see a downward event come down here and flush out before we find some sort of real base. But I'm optimistic that we've already seen the base, and we're trying to find the base bottom right now moving into 2023. And that would mean this fear level would move back down below 7. We would start to flag back out and transition into what I'm calling new normal for 2023. And that would mean this level here would continue to flag out, maybe stay in this 350, 370 range, and attempt to then start to move higher as we start to appreciate upward. Lastly, consumer engagement. The move of the Fed over, this is a monthly chart, over the past couple months has completely deteriorated consumer optimism. We're now down back here at this 15 level. I'm just going to draw a line right across here and understand that that puts us at 2011 and 12 highs. So where we're at with consumer optimism is, really equal to or below the 2011 and 12 highs. That's right after the global financial crisis. Consumers really believe that we are going to unwind at a broader basis, which means that we could see some real capitulation lows take place over the next 4, 5, 6 months. And what we need to be aware of is consumer engagement pulling away from the market like this is going to decrease GDP. It's going to decrease the opportunity for the markets to actually re-engage back to the upside. So we have to be very, very cautious of the fact that we could have some sort of a capitulation event. I'm not going to call it a contagion event because that would mean that we would likely see some sort of a broad breakdown in trend. But a capitulation event, which would be kind of like a spike low like this, or deep, deep selling where it reverses back here into January, February, you know what, ladies and gentlemen, that could happen. So you can see these deep, deep lows, November 2014, November 2017, and then here, early January, February, March 2020, that was the COVID low. We've already established this low. We've come down and seen this extreme selling capitulation event. If we get a capitulation event here into January, starting to move higher, it would be very, very interesting, in my opinion, if we did see something bottom, base, form a capitulation low here and attempt to rally back up into some springtime, let's call it reflation trade. But we need to see how it plays out. We're pretty, I mean, if you were to look at it from a standpoint of, you know, optimism, I'd say optimism right now is like a 1 or a 2 on a scale of 10. But optimism at this point may be the best outcome simply because we've extended through this deep unwinding phase. The Fed has already deflated consumers, deflated real estate, really moved the needle. Gold and silver are starting to move higher, which is a sign of accumulation. This could be the sign that we're nearing a capitulation low in the global markets and in the U.S. market. So we'll just have to wait and see. Lastly, the accumulation cycle phase. We have seen this. These are 9.5-year cycle patterns. I want you to be aware this is our inverted head and shoulders pattern right over here. We've ended a cycle phase, a major cycle phase. You can see here we had gone through a series of cycle phases here. Then we ended a major cycle phase here. We're transitioning into a new cycle event, which should last about, if I do the math right, from here, roughly from here to here. So that's going to be about 20 months. So understand that if we start 2023 and we go about 20 months out, that'll put us towards the end of 2024, which lines up perfectly with my 2025 cycle event. Let's understand that we have this cycle event here, March 2025. So that would line up perfectly with the idea that we could reflate. We could see devaluation in real estate. We could see devaluation in home prices while we see stock prices continue to reflate. And that would mean that this would move downward. The accumulation cycle phase would move downward, which would indicate that you can see here that accumulation takes place in a downward cycle phase like this. Then we get into distribution phases here, distribution phases here. You can see how it started to distribute in early 2022. These are where people are getting out of stocks, moving more protective. And now we've had this peak here, and now we're starting this down cycle. I would expect this to transition back down into this lower level right over here and potentially stay that way until the end of 2024. We'll see how it plays out. So that's the update right now. And again, I'm trying to give you a broad perspective. I think we're going to see this move into a sideways basing mode, attempting to reflate. Now, again, the stock markets can go up while houses are deflating and struggling. That happened back in the early to mid 80s. If any of you are familiar with it, which I lived through it, you can be certain that the U.S. stock markets and consumers will still continue to spend while housing markets struggle to really gain like we've seen. So given what we have seen with the massive increase in the housing market, I do believe a 15 or 20% decline is reasonable and expected over the next 18 plus months. That would mean, again, if we come back over here, oops, wrong direction. From where we're at 370,000, let's call it a 15% decline would be a 45 to 50,000, call it 55,000 price decrease from where we're at. That would put houses back in the 320 range, back over in this area, 320, yeah, right around that area. And if we get into a deeper price decline for moderate or median house prices in the U.S., we could be back into the 270, 260 area. And that would mean that, really, when you consider that we were up here in the 425 area, that's looking more like a 35, 40% median house price decline in the U.S. overall. If we get into a deep decline area like this, where we actually see prices drop 40, 50%, you're going to see the Fed start to change direction even though commodities and inflation may be quite high, you're going to see the Fed start to really move to a more neutral stance and trying to save the housing market. We just cannot withstand another crisis event at the hands of the Fed here. So be aware. We have, at this point, we have really 2023, 2024, and then early 2025, we reach the end of a depreciation cycle. Now, at the end of this cycle, we could go 12, 15 months into it with extended basing and bottoming, kind of like we did back over here before we saw any real growth. So understand that we had to wait till real 24, 15, 16, 17 before we started to see real appreciation in the market. And that could be very well coming. A highlight this week is that we are at the most hostile housing market environment that we have ever seen. I mean, it is worse than 2006-07. It is worse than 2015-16. That was moderate. We are at the most hostile housing market environment that we have ever seen right now. And that could lead to some very big disruptions. So pay attention. All right, guys, again, big changes coming to the website. Follow me on Twitter. Follow me on YouTube. I hope you guys are enjoying this and staying protected. Have a safe and happy new year. And we'll see you in 2023.